So I'm going to start with your other hat on, not your governor hat, but your vice chairman hat on the Financial Stability Board. So the Financial Stability Board has done a lot. You just put out your letter to the G20. One of the issues that is in that letter and that you're trying to address is market fragmentation. So how do you see fragmentation impacting the financial system, and can something be done about it, or is it just not having as much impact as some of the people in the private sector think it's having?
Well, I think it is having an impact, so there is absolutely no denying about that. But I think you should make a difference between fragmentation that is simply there because there are domestic mandates for policymakers that they need to fulfill, which can lead to sort of local gold plating, as it is called, but local requirements on top of international agreements. As a matter of fact, in the Netherlands, we only this week we increased risk weights on mortgages, for instance, which is a national measure on top of the international Basel agreements, etc. And there is also some fragmentation, which has more to do with different traditions, different cultures in supervisory agencies, which often is in the plumbing, I would say, definitions of default, definitions that go into certain regulatory standards. And there, I think we can make an effort to actually reduce that to the extent possible. In the derivatives sphere, we're working on deference, for instance. In the TLAC sphere, we're thinking about sort of pre-positioning of capital and liquidity. So there you can have a sort of critical look whether everything that is now also being introduced from a national perspective, whether that is truly necessary to contribute to the goals that we've set ourselves.
So let me take a little bit on that. So pre-positioning, which a lot of people call ring fencing, the Federal Reserve just came out this week with their new proposal, which includes, actually, I thought it was an interesting point that they made, which is on branch liquidity issues. They said they have not been able to figure out exactly how they want to resolve it, but one thing they did do is they basically said, let's internationalize this, because let's not create just a standard here in the United States, and then it gets copycatted and maybe copycatted in a worse way overseas, and then you create the problems of fragmentation again. And so do you see the FSB trying to take this on, and in some respects helping out the United States and the Fed try to think through this, but also at the same time making more of an international standard in this area?
Well, at this moment, we are actually in the process of evaluating the TLAC standard and the too big to fail, all the measures that we took under the heading of ending too big to fail. This is clearly one area that is under consideration. I think proper process would be to first do the evaluation and then sort of to look at specific measures that we can take in this area. I would say, though, that in the US there is a tradition of whole bank bail-in, whereas outside the US there are different bail-in strategies being pursued, multiple point of entry strategies. And those are the types of strategies where local supervisors worry a little bit more about what would happen in their host jurisdiction if it came to a resolution of an internationally active firm. And there the question, of course, is can we accommodate their concerns while at the same time not raising, let's say, unnecessarily high barriers to the free flow of capital and liquidity in the firm.
Okay, very good. Since you mentioned evaluation, and we were talking in the green room about, the FSB at this point in time has done a good job over the last 10 years. There's now looking at evaluation issues on a number of areas, and then there's going to be kind of looking forward, what are the issues to think about. So let's think for a second about evaluation issues. The big evaluation going on right now within the FSB is the too big to fail agenda, which is obviously, in some respects, the biggest agenda there is out there. But how do you see that process going? And hopefully that evaluation suggests where there's been some mess ups in the past, but we can fix them.
Yeah, this is a very interesting one, because in some ways this is also a different evaluation from the previous two that we concluded. The previous two on infrastructure finance and on SME finance, which is about to be concluded, these were entirely focused on, let's say, whether there are unintended side effects of the measure, but they were not so much focused on the usefulness of setting aside capital for infrastructure exposures and SME exposures. In the area of too big to fail, the evaluation will not be only about unintended side effects, but it will be the much more direct question whether actually the measures that we've put in place have contributed to the goals that we set ourselves. There was a situation before the crisis which we found unsatisfactory, the wrong incentives in place. And so one of the questions here, and that I think is a much trickier question, is to what extent have we actually removed these perverse incentives? Ending too big to fail, I've always been saying that this is probably misstating the question a little bit, because it suggests that this is sort of a digital, either there is a too big to fail or there is not. In my view, we are significantly reducing too big to fail incentives, and the evaluation hopefully should give us some evidence how far we have succeeded in that regard. Okay. But we will not know until, of course, we would be at the point of failure of a large internationally active institution. So maybe we should just hope that we will never find out how successful it is. But
okay, before I should remind everybody, if you have questions, please send them in, and I'll try to get them off of the iPad that they've set up for me here. So let me look forward. All right, so the way sometimes we put it in the United States is what keeps you up at night. So you are the chair of the Vulnerabilities Committee within the FSB. There's a number of vulnerabilities out there. Some of them you've identified within your letter to the G20. Some of them I'm sure the IMF has identified. Which ones are you guys thinking about? And I'm not saying scares you the most, although I'm happy for you to answer that, but much more, what are you thinking about, and are there any policy actions that you're thinking about taking on those areas?
Well, I think most of the vulnerabilities that we currently identify are related to the lower for longer, I would say. And in that sense, there has been even a bit of a change, I think, in the last few months, or let's say a year or so, that thus far we were thinking about a world in low for long. Now we're thinking about lower for longer, and some would even say low forever. Yeah. Well, I hope not. But it's pretty clear that we need to think through quite structurally what that implies in terms of risk-taking in the financial sector. And one area that is already longer, for a longer time, a little bit an area of concern is, of course, in the area of corporate indebtedness. Mm-hmm. The leveraged loans, the fact that of the corporate exposures now, some 30% of all of them is BBB or less. Mm-hmm. The fact that covenants are becoming lighter and lighter. And there's a reason for that, but that is, from a financial stability perspective, is quite worrisome. And this is also an area where, in all honesty, you can talk about macroprudential instruments, but most of the macroprudential instruments we have actually are related to housing markets and banking and consumer finance, but not to the corporate space. So also here, the availability of macroprudential measures is really not all that abundant, let's say.
So on the leveraged loan market, this is it's an interesting question, but is it a problem that you see as being a potential systemic risk, or is it just a problem of, yes, there's some leveraged loans that are out there, and so there are some people and some investors and so forth that are going to get into trouble, but it's not necessarily systemic. It just may be that somebody's going to take a loss.
Well, there are arguments on either side here. First of all, I mean, if you look at these loans are spread through the financial system, through CLO structures, etc. These investors are not confined to the US.
Yep.
You can find them everywhere in the world. If you look at the Global Financial Stability Report that the IMF issued, life insurers in Japan and Taiwan are heavily invested in this kind of exposures. It's just not to pick them. I mean, I could pick also other examples of institutional investors or asset managers elsewhere. So I think that these risks have spread through the financial system. Now, often a comparison is made with respect to the subprime and the CDOs before the crisis. I think that's not entirely fair. I think the CLO structures that you're seeing are actually simpler and more transparent than the CDO structures that we saw 10 years ago. There's less dependence on short-term funding. the role of the banks, fortunately, this time is a little bit different. There are not these implicit guarantees that played such a large role 10 years ago. So there is also a couple of reasons to be perhaps not to overdo the analogy of 10 years ago, but the fact that the analogy is made, I think, tells something about sort of the worries that we have in this space.
Okay. I want to come back to one more vulnerability, but you did mention the lower for longer. So there's been a concern or a complaint from a lot of financial services firms, including insurance and pension firms, about negative interest rates and what it's doing to the financial system in Europe. How do you think through that and evaluate it? And is the negative interest rate environment, is it working? Because there's a question as to whether or not this is actually working.
Yeah, that's a multi-pronged question. I would say that thus far, negative interest rates have been an integral part of sort of the easing that central banks have produced, particularly in the euro area. And to the extent that negative interest rates have contributed to sort of growth, credit growth in the economy, the recovery of the economy, on balance, I think it is fair to say that the effects have been positive. Mm-hmm. Also on the banking sector. The question, however, is can we also count on the positives going forward? As long as interest rates are declining, we know that there are valuation gains on the asset side. And yes, there is the problem, particularly if you come to the banking sector, that it will be very difficult for banks to start also levying negative interest rates on retail deposits. So the longer the situation is there, it will erode bank profitability, and it will become a more problematic situation. And some of the offsetting factors that have taken place in the past may not be there as much in the future. So yes, this is a concern. Now, of course, there have been other parts of, let's say, the mix of monetary instruments that have been employed, the TLTROs, for instance, which have helped a lot, the tiering that has now been applied. But there is a concern about bank profitability and negative interest rates. And for the insurance and pension fund industry, this is, of course, a very, very difficult environment, particularly in those countries where you have defined benefit type liabilities, which are then discounted at a market interest rate, which is essentially zero or negative. It's a big problem for the pension fund industry in my country, for instance, mm-hmm. which is to a significant extent underwater and is struggling with how to sort of get out of this situation of underfunding. And undoubtedly, this is the case for life insurance industries in other countries. So yes, for all the financial firms that offer retirement projects with a guarantee, this is very problematic.
Okay. So the other vulnerability I think that I hear coming out of the FSB fairly often is about cyber issues. So there's a number of factors in there. Some of them are about operational resilience. Some of them are about some more digital issues than cyber issues, which is we just heard the central bank governor from Croatia talking about stablecoin. Which are the areas that you see as potential vulnerabilities for the system? And then I think I'll come back and ask you a secondary question, which is about more the stablecoin, which maybe that's the one you see, but I'm doubting that. So I figured I'll just ask first, a vulnerability that you are most worried about in the cyber area, is that just we just need to do more study and more work right now, and it's not a huge concern?
Well, no. We need to do more than just studying in this area. I think we need to do ethical red teaming, for instance, apply that as an instrument to our sort of critical financial infrastructure. So cyber resilience, I think, is a big assignment for central banks and supervisors. It has some international components, but it also has simple domestic components where supervisors need to sort of get into these activities with the banks under their supervision. And as I said, ethical red teaming, at least in the Netherlands, we think that we have some positive experiences with that. At the same time, we've seen that this is also an international issue. A lot of these cyber attacks come from different jurisdictions. If you look, for instance, at the website of my own central bank, it's attacked almost every second. So, and we register the number of attacks. Most of the attacks are coming from IP addresses in 2 or 3 jurisdictions in the world, not to be mentioned here, but nonetheless. So yes, this is, I think, an issue not only for commercial banks, it's also an issue for central banks. And well, the more we depend on information technology, the more we need to manage this risk.
Okay. All right, and then let me, on stablecoin, I know the G7 is supposed to be coming out with their report later today. They've had a working group that's been working through this. I'm assuming, and I could be wrong, that at some point they're going to say, all right, we need the FSB or the Basel Committee to do a little bit even more analysis on this. The CPMI has kind of done what they possibly could. So do you, as the vice chair of the FSB, do you see a discussion happening on stablecoin? What's your view on it? There's a variety of different ones. Obviously, Libra is the one that gets most people's attention, but it's not the only one that's out there. So how are you thinking about stablecoin issues?
Well, we've been, from the FSB's perspective, studying crypto assets already for a while, and we've issued some reports on it, and thus far the conclusion was always that we didn't see any sort of financial stability risks yet, because most of them were fairly limited in size and scale, and that's why also most authorities took a little bit of a sandbox approach. Let's not stifle innovation, so let's take a little bit of a wait-and-see approach, and apply only those regulations which we really think are needed to be applied. And that worked for a while. But now, and this is language that I'm taking from Benoit Cœuré, who chaired the G7 group, actually there is an elephant all of a sudden in the sandbox. And that's a problem, because this is a big tech firm which is now becoming active here, and which means that we, from the central banking community and the supervisory community, we now need to get our act together, actually much more quickly than probably we thought, let's say, 2 years ago. So what kind of messages do I take from the fact that we have the Libra and possibly the other stablecoin initiatives? Well, first of all, that on the public side, the breeding ground for these initiatives is the fact that still cross-border payments are very costly, very slow, and very difficult. So we do have sort of real-time gross settlement systems within our jurisdictions, but once you want to sort of make a payment between our jurisdictions, all of a sudden it takes a lot of time, it takes a lot of costs, sort of the liquidity risk, the AML risk, which puts banks to a lot of costs associated with these activities. It has led a lot of banks to actually withdraw from correspondent banking and from facilitating these remittances, for instance. So that's the first thing. We need to solve that problem. And as long as we don't solve that problem, I think these initiatives will continue to pop up. Now, secondly, these initiatives also pop up because it's financial innovation. I mean, this is digitalization, and I don't think we should stifle innovation, that we should not see that as our role. However, we need to be prepared in our regulation, and I would say that our current regulatory structures are probably not sufficient to deal with these initiatives, because these initiatives are, from day one, immediately international. And most of our regulatory structures are still sort of have the emphasis is on national authorities with national mandates, etc. So they need a lot more international cooperation than we already need in the traditional forms of financial services provision. And that is where I think we also need to speed up our work, that we need to identify the regulatory gaps and work on our regulatory structures so that if these initiatives continue to be presented with us, that at some stage we will be ready to deal with them. As I said again, it is a form of innovation in and of itself that I think is always welcome.
Excellent. So let me switch a little bit from the FSB world to Europe. So there's some vulnerabilities in Europe. One of them is a good trading partner of your country, which is the UK. There appears, although I haven't checked the news lately, to be decent news coming out of about what's happening on the Brexit negotiations. But how, I guess, do you see this in the Netherlands as the could Brexit create big problems or problems for your country as a major trading partner with your country? Or do you see this as being a problem that can be overcome, and so therefore going forward it won't be as big a deal as sometimes we make it out to be?
Well, I clearly wouldn't take the latter position. I mean, the UK is a big trading partner for us. I think it's the number 3 or number 4, I think, trading partner of the number 4, I think, of the Netherlands. So Brexit, one way or the other, it will mean the more disruption in international trade. International trade will not be as undisrupted as it was previously, and that is bad news. That's bad news for the UK. It's bad news for their European trading partners. Now, the only thing that we can do collectively as policymakers is try to make the bad side of it as small as possible, and that is by having as much as possible a negotiated Brexit with a smooth process where we will not sort of create facts on the ground for each other, where there will not be cliff edge effects, etc. In that sense, there is some good news, in the sense that there is an agreement. The market is not yet convinced that that agreement will make it through UK Parliament. The vote is on Saturday. There's still some time, I think, between now and Saturday. I'm not a connoisseur of British politics, and if I thought I was until 3-4 years ago, I would never say so anymore. So let's wait and see what will happen on Saturday, and let's hope that at the end of the day, rational decision-making will prevail.
Okay. All right, so this is a question from the audience. And I'll be careful how I phrase it. So, President of the ECB, Mario Draghi, after the monetary policy decision last month, said we can't rely on monetary policy. We've got to start thinking about fiscal policy issues. And in that, one problem that does exist is that the countries that have more fiscal space, in some respects, don't want to use it. And those that want to use fiscal don't have any fiscal space. And so does then that mean over the long term that we just have to come back again towards somehow monetary policy is the only real tool that we have for Europe as a whole to continue to increase its economic growth and not to have disinflation?
Well, I can't say too much on monetary policy. For ordinary mortals within the European Central Bank, this is the silent period. Yep. So it's pretty clear that this whole notion of monetary policy being the only game in town is a very uncomfortable position to be in. So I think broadening the policy scope, and this was actually also the title of a speech that I gave 2 days ago on this, I think is very welcome. I am coming from a country where I think there is fiscal space, the Netherlands, where I think also gradually the thinking is changing and this space is actually being used. So what you're seeing in the Netherlands is that the process of debt reduction and of financial consolidation after the financial crisis has come to an end. Mm-hmm. It's, in my view, it's finished. I mean, our debt ratio will decline to 47% next year. I see no reason for sort of wanting to drive public debt down even further. I think it's a good thing to at least have some public debt in an economy with the financial sector that needs safe assets, with an economy where the private sector has a huge saving surplus already. So, and that almost mechanically means that there will be fiscal space in the budget, because if you continue to have budget surpluses, then your debt will continue to go down, and there is no need for that, as I have said on earlier occasions as well. So in the budget for next year, there was a tax cut, which for, I think, 2/3 was unfunded, which means fiscal expansion. There is a lot of debate in my country about having an investment fund, using today's opportunity to make some public investments in strengthening the supply side of our economy, so strengthening the growth potential of our economy. And that's, in my view, also the way to look at this. There is the fiscal space. We can use it to make sure that we lift potential growth, that we invest a bit more in education, in digital infrastructure, and I think it is happening in my country, and I sense that a similar change in thinking is also taking place with in a country that is relatively close to the Netherlands, which is a bit bigger and would also have somewhat more influence on euro area aggregates. So yeah, I think that's good news.
Okay, fair enough. Let me ask one last question, which is around, we've been doing a lot of work here at IIF on sustainable finance. It is something I know that your central bank has actually looked at very carefully in terms of on climate risk and stress testing. How is, in the FSB, is the FSB going to be able to take this agenda forward? Because I know that there is disagreement, obviously, within the members on these issues. But at the same time, it seems like it's being identified by a number of central banks. I mean, Mark Carney's been probably the clearest on this, but he's not the only one. And so how are you thinking about it, both from your perspective as central bank governor of, and also as vice chairman of the FSB?
Well, actually, I'm coming from the Netherlands, and we have concrete experience with a climate stress test that we run on our financial industry last year. And we are continuing to work on fine-tuning that methodology. My colleague Frank Elderson is the chair of the network on greening the financial sector. So we continue to push this agenda quite a bit. And I think at some point it will also arrive at the FSB's table, because this is simply a source of risks that needs to be managed. Yeah. Whether you like it or not, our economies will have to undergo an energy transition. And that will have an impact. There will be physical risks associated with climate, but there will also be transition risks associated with the kinds of exposures that financial institutions have. And these risks will have to be managed like any risk that will be managed. At some point, these risks will become financial risks. So at some point, we will say that there's nothing special about these risks from a perspective of the financial institution. They will simply have to be incorporated in risk management, in supervision, in stress testing, and the like. And then also the FSB is actually intending to do some work in my committee, the Assessment of Vulnerabilities Committee, because we want to know more about it. We want to also be able to make international comparisons, to identify good practices, sort of learn from each other. I think that's inherent in our mandate and the kind of activities that we undertake.
Thank you very much, and thank you again, Governor Nutt, for joining us. I know you're very busy this week, and you've been very, very nice to us to be here today, so thank you.
My pleasure.